But investors, of course, were rattled yesterday over renewed U.S.-China trade tensions, sending all the major averages down better than 3% on the session, 800 points lower on the Dow. Beijing broke its silence on that 90-day tariff trade truce, promising that there is a clear timeline on trade negotiations. I spoke with Treasury Secretary Steven Mnuchin yesterday to talk about these developments.
We have a lot of work to do, but I think this is the first time you've had a direct agreement between the two presidents, President Xi and President Trump. I think President Xi made some very strong commitments on changing structural and non-structural issues. And if we can get this negotiated and get a real agreement, I think this is the single biggest opportunity for U.S. business and U.S. workers.
And joining us right now is CFRA Research Chief Investment Strategist Sam Stovall. Sam, it is good to see you this morning.
Good to be here.
Big sell-off yesterday. Now, we got profit growth in the third quarter, year over year, of 29% this year. Next year, you're expecting profit growth of?
7.5%.
That is a sharp slowdown. Can you explain how profit growth goes from 29% to 7.5% within a year?
Well, I think two reasons. First off, it's because the bar was set so high this year. At the beginning of 2018, Wall Street was looking for an 11.5% gain in earnings. Now we're looking at more than twice that amount because of the stimulus from the tax cuts. But looking to 2019, because now the bar has been set so high, even though we are going to be setting a record in terms of pure earnings, the year-on-year growth rate will be slowing.
Oh, that makes sense. To
the point where it's now 7.5%. But at the end of the third quarter, meaning just ahead of the third quarter reporting period, analysts were looking for a 10% gain in 2019 earnings. So that has been trimmed because of the uncertainties surrounding trade as well as surrounding interest rates.
Yeah, you have tougher comparables. I mean, you can't grow at 20%, 25% quarter after quarter after quarter after quarter.
It's only been a couple of quarters, but yeah.
Right, exactly. But the nice part is not going to go into negative growth, meaning it really hasn't been a sugar high, that the fundamentals of the economy are actually underpinning the growth for even next year. We're remaining strong. But what's fascinating that I looked at is a lot of the defensive sectors, or the perceived defensive sectors, have held up very well since October 1st, the market sell-off. I look at the industrial real estate, it's still up 3.5% compared to the market selling off 7.5%, because you have the stability of the cash flows coming through. Do you think people should position themselves in the best leg of growth for next year, considering we are going to have tougher comparables?
Well, I think that we need to get confirmation on Friday as to whether the Fed probably will be slowing its rate tightening program in 2019.
You mean with Friday's jobs number?
Exactly. Because if the Friday's job number comes in greater than the 200,000 that's expected by the street, better than a 3.7% unemployment rate, and the 0.2% gain in hourly earnings, if that comes in much, much stronger, then I think investors are going to worry, maybe the Fed won't be able to slow their rate tightening.
Well, Secretary Mnuchin talked about the labor participation rate with you yesterday. He's worried about people coming into the labor force. We know we have tons of jobs out there, but he was telling you that yesterday.
Yeah.
Isn't what's going on in the market enough to tell Jay Powell and his company down in D.C. to hold up with the difference between the 2-year Treasury and the 10-year Treasury? It's the most narrow difference since 2007. People buying 10 years are telling the Fed, you're fouling up. You're slowing the economy too much if you intend on raising interest rates at the pace that people still expect.
Which is why Ray Dalio said the Fed's not going to be able to raise 3 times next year.
Well, but the question is, historically, the Fed funds rate is 1.3 percentage points above the year-on-year change in core CPI. Fed funds should be closer to 3.5% than sub 2.5%.
Let me ask you a question before you go. You saw this market sell-off yesterday. Would you put money to work in this market right here?
I think that wait for the mid-December low, and then as the Stock Traders Almanac says, you've got a free lunch on Wall Street.
You love that Stock Traders Almanac, don't you? Sam, it's good to see you.
Good to be with you.
Thanks so much. Sam Stovall.